Glyn, we've seen a buoyant start to the year so far. What are the main drivers behind that?
Well, there have been two key factors in driving equity markets in the past few months. One is the evidence of steady economic recovery in the US. Remember, a few months ago, people were still talking about a double-dip recession in the US. That's been off the agenda, and all the data that's been coming out until recently has confirmed that the US economy is on a steady recovery path. And of course, the US economy is still by far the most important, the biggest in the world. And the second factor, and I think by far the most important, was this huge injection of liquidity by the European Central Bank, the long-term refinancing operation, two tranches just before Christmas last year and again at the end of February, provided a huge injection of liquidity. So those were the two things that have driven markets forward so far this year. It's fair to say that some of the effects of those factors have been waning in the past month, and markets have been more mixed in March than in January and February, when they were really uniformly very strong.
We'll come back to those two main topics later, but in the meantime, what are the main drivers in the markets?
Well, interestingly, the markets in January and February had been performing uniformly very strongly, but we saw much more mixed returns as March evolved. Over the course of the month, developed markets globally, as measured by the MSCI World Index, were still ahead by just over 1%. But within that, really only two major markets made any significant progress. That's the US and Japan. Both rose by over 3%. And incidentally, Japan has now risen by 20% in the first quarter, making it by some margin the best performing market in the first quarter, helped by recovery from the post-tsunami recession and by some weakness in the yen helping exporters. But it was really only the US and Japan that made progress. Other markets, Europe and Asia, were down somewhat. Asia actually a bit more than Europe. And intriguingly, emerging markets, which have been performing so much better than developed markets in the first 2 months of the year, underperformed and actually fell by over 3%. So quite a marked divergence of returns between markets.
So generally speaking, the performance of the equity market is suggesting more risk-seeking behaviour, and yet the emerging markets are down. What's driving that?
Well, I think the main thing was what's happening in China. China, as we know, has been the great growth engine over the past several years now for the global economy, and amongst emerging markets, the best performing economy. But we have seen some evidence of a slowdown in the Chinese economy. And in fact, the Chinese authorities in the course of March lowered their growth forecast for the Chinese economy from 8 to 7.5%. It doesn't sound very much, but I think it's a confirmation that these extraordinary growth levels that we've seen from China in the past decade or more can't really be sustained. We do need to see some rebalancing of that economy. The authorities know that, and there has been quite clear evidence that we're seeing a slowdown in manufacturing, slowdown in exports. The trade surplus has fallen dramatically over the past year or two. And we know, of course, that the property market remains somewhat stressed. Now, China is extremely important. It had a big impact on emerging markets generally, which generally fell. It also had an impact on commodity markets. China being the world's biggest consumer of many commodities. We saw demand weakening somewhat, prices falling across the board quite sharply in the course of March. And indeed, we even had some of the big iron ore producers, BHP Billiton was one, which came out and noted a softening in demand for iron ore. So what's going on in China had quite a significant impact on both emerging markets and on commodity markets.
Okay, so generally speaking, commodity markets weaker, but oil's up again.
Yes, it's slightly perplexing what is going on in oil. And the intriguing thing is that the oil price is now up by 15% so far this year. It was up again a little bit during the course of March. There's not an immediate supply shortage, but I think there's a fear about supply shortages, particularly if the Iranian situation were to deteriorate further. And I think this is all about short-term supply concerns. If you look further out, for instance, 5 years out, 5-year oil price futures are actually trading at about $95 a barrel compared with the spot price of $125. That's the biggest discount we've ever seen, futures to spot. So it suggests that what we're looking at are short-term supply concerns and fears, whereas the longer-term situation is actually better balanced. Having said all of that, the fact is that at the moment we're having to pay globally $125 a barrel, and that's certainly having an impact on consumer sentiment, consumer confidence and consumer demand. So it's a concern for markets.
Turning then to the main consumer of oil, the US, much of the data from there last year was very strong. Things seem to be coming off the boil a little bit now, particularly looking at business sentiment. What are the main themes there?
Yes, look, there's been some little softening of data in the US in the course of March, but I think it's important to step back just a few months. You know, the fact is, a few months ago, people were very worried about double dip. As I mentioned earlier, that is clearly off the agenda. We have always said that we think the US economy can grow by 2–2.5% this year. Despite this little softening we're seeing now, there's no evidence to us to suggest that those forecasts need to be changed. But we certainly don't believe the US economy is going to accelerate to the normal sorts of recovery you would get after the deep recession that we had in 2008-9. And of course, the reason for that is this whole process of deleveraging that's going on, and we know that fiscal spending has got to be cut back post-election this year. So yes, there's been some softening in the US, and it's been an important factor in holding markets back a little bit in the course of the past few weeks. But we still think that modest recovery, 2–2.5%, is intact.
Turning to Europe, the Greek debt situation has been resolved, it would seem. And generally speaking, the amount of liquidity put into the system now by the ECB has settled nerves quite a lot. Are we out of the woods?
Well, it would be nice to think that we were, but I don't. I think we've got quite a long road ahead before we're really out of the woods in Europe. Yes, the fact is that the Greek debt restructuring was agreed early in March. Private sector bondholders took quite a substantial haircut, as we all know. The deal was done, but it wasn't very long after that people began to say, well, Greece might need yet another sort of third bailout, another round of restructuring. But more importantly, Spain, a much bigger economy, but one of those sort of peripheral economies that's been having difficulty, as we know. Spain came back into investor attention. We saw the economy slip back into quite a significant recession. Unemployment in Spain is a real worry, and unemployment levels have reached record highs at 23–24% of the workforce. Youth unemployment is close to 50%. The banks need further restructuring in Spain. We saw during the course of March bond yields starting to rise again in Spain, having fallen quite a bit with the help of the ECB's long-term refinancing operation earlier in the year. So I think it's a salutary reminder that the European debt crisis still remains a crisis. It's a multi-year process of deleveraging, paying down those debts. The final outcome remains somewhat uncertain, of course. There's still a question mark over whether the euro will survive all of this. The ECB, through its LTRO, bought time, but it couldn't solve the fundamental underlying problems, and that's a long process. And I'm sure as the next year or two goes on, we'll continue to see these bouts of nervousness and concerns, just as we're seeing at the moment about Europe.
Thanks, Glyn. So all in all, quite a mixed bag. Looking forward, what themes can we tease out of this?
I think there were some important things to focus on in March. Yes, there was some greater uncertainty as the month evolved surrounding some of these big issues that I've talked about: the state of the US economy, the Chinese economy, European debt situation. But intriguingly, there was no great flight to safe havens. So for instance, US Treasury bond yields actually went up over the month, whereas when you get a real crisis in markets, people flood into treasuries and yields go down pretty sharply. That didn't happen. So I don't think we're seeing a dramatic rise in risk aversion. We're seeing investors perhaps taking stock a little bit. There have been very strong rises in markets in the past 3 or 4 months. Some people are taking profits. Valuations are still reasonable. And in fact, that's an important underpinning as far as we're concerned. They're still reasonable, but of course they're no longer as compelling as they were a few months ago when markets were on their knees. So we're seeing a bit of profit taking, a bit of circumspection, this little bit of softening of data from the US and China, and the European debt situation being a worry. So I think all of that suggests that we'll go through a period of consolidation, perhaps markets drifting back a little bit as we've seen early this month. But we don't think markets are going to come back too far, and certainly on a medium-term view, with the corporate sector in very strong shape, reasonable evidence that the US economy is going to continue to grow, Europe bumping along the bottom. We think on a 2 or 3 year view, equity markets still will provide some very attractive returns for investors. And bond yields at these levels, government bond yields at around 2–2.5% in the highest quality markets, just simply to us look pretty poor investments. And in that area, we focus our investments on corporate bonds, credit in particular.
Thanks, Ben.